Hello friends, let us continue with our discussion on cash flow statement, right? Cash flow statement. In this we started with cash flow from operating activities. What are the three activities? Operating, investing and financing. And we started with cash flow from operating activities, right? We discussed what are operating activities. Any activities relating to the routine operations of the business and that involves cash inflow or the cash outflow are the operating activities. I told you about the two conditions to be considered. Two important conditions to be considered. One is whether that activity is an operating activity or not. Second is whether that activity involves actual inflow or outflow of cash or not. Clear? If any one of the condition is not satisfied, that means that particular item does not belong to operating activities. Clear? Now, then we started with the steps. First of all, we said we calculated net profit before taxes and extraordinary items. Right? The first step was calculation of net profit before taxes and extraordinary item, then adjustment for non-cash and non-operating items. Right? So the two conditions are whether the item is operating or not, whether the activity is operating or not, and the second is whether the activity is cash generating or not. So we have to check two conditions. Here also, here we check on the items which are directly related to the net profits in step 1. In step 2, we consider those items which are not directly related to net profit. In this we say we will add back provision for doubtful debts. Then I told you about depreciation or goodwill written off. Then loss on sale of fixed assets. Right? Similarly, we subtract any interest received. We subtract any gain on sale of fixed assets. Clear? Okay. Then whatever the amount we get is, whatever the amount that we get is, we say as net profits before working capital changes. Right? Okay, this much is clear. This much we have discussed in the previous lectures. Now, moving on to the third step. Third step is adjusting working capital changes. Now, what does this mean? If we say we have the working capital changes, what it means? The first of thing it means is it refers to changes in our current assets and current liabilities. What is working capital? Working capital consists of our current assets and current liabilities. The capital that we are using in routine, that we are using in the operations, right? That involves current assets and current liabilities. So if there are any changes in the current assets and current liabilities, that we will refer to as working capital changes. Now, talking of current assets, what is included in current assets? I can say inventory, right? Because inventory is a fast moving article. You produce the goods, you sell the goods, you produce the goods, you sell the goods. Your inventory keeps on rotating. It is your current asset, right? You keep on producing goods and you keep on selling the goods. This is your current asset. Now, listen to it very carefully. You say, we are given the balance sheets for 2 years, 15 and 31st of March 2016. I say inventory as at 31st March 2016 was 1 lakh, and as at 31st March 2016 is 70,000. Now, can you tell me the reason for the difference? There is a difference of 30,000. Earlier we have the inventory of 1 lakh. Now we have inventory of 70,000. Clear? Clear, friends? What does this mean? This means that we have sold inventory of 30,000. We have sold inventory of rupees 30,000. Isn't it? So if I have sold this inventory of 30,000 during the year, if I have sold an inventory of 30,000 during the year, this is what? Cash inflow for me. Isn't it? 30,000 is coming into your pocket. You have sold goods worth rupees 30,000 and 30,000 you have pocketed. This 30,000 is cash inflow. And is this related to the routine operations of the business? Yes. So it is an operating activity also. Right? So this is an operating activity also. Clear? Now, if we talk from the cash flow point of view, your inventory is decreasing. Your current asset is decreasing. That means there is a rotation of current asset, right? You have sold your current assets to some extent. That involves cash inflow. So this will be I can say decrease in current asset will be added back to net profits. Why it is added? Because it involves cash inflow. This is increasing our cash. Therefore, we will add back any decrease in current assets. Similarly, if you see the debtors, if we talk of debtors, on 31st of March 2015 and 31st of March 2016, here you have debtors of 1 lakh, here you have debtors of 70,000. Right? This means you have recovered 30,000. This is cash inflow. Clear? Now, if you have the debtors of 1 lakh here your debtors have increased to 1,70,000. Sorry, say okay, 1,70,000. If there is an increase of this rupees 70,000, what does this imply? You have sold the goods. You have sold the goods. Okay, more by 70,000. You haven't recovered the money from the debtors. Your debtors have increased from 1 lakh to 1,70,000. Okay, so any increase because this is your investment, your money investment will increase by 70,000 here. You have given the money, you have produced goods worth rupees 1,70,000 by paying out of your pocket. You have not received that money as of now. So amount has gone out of your pocket, right? But this amount is yet to be received from the debtors. So I will say increase in current assets will be subtracted from net profits. Clear? So simple rule to remember in exam is increase in current asset, you have to subtract, go in the reverse direction. Decrease in current asset, add back. Clear? Now, talking of current liabilities. Current liabilities like trade payables. Right? On 31st of March 2015 and 31st of March 2016. Right? Here your trade payables were rupees 1 lakh. Now your trade payables are 70,000. That is, the amount payable as at 31st March 2015 was 1,50,000 and as at 31st March 2016 is 70,000. That means you have paid rupees 30,000. That means this is a cash outflow. If this is a cash outflow, we will add back or subtract. Cash outflow will be subtracted from the net profits. It will be subtracted from net profits. Right? Your trade payables, your liability is decreasing. That means you have paid off that amount. Clear? Similarly, clear? If there is an increase in the amount, that means we have borrowed more money, right? That means, see, if you have trade payables, say 31st March 2015, you have trade payables of 1 lakh. And as at 31st March 2016, you have trade payables of 1,50,000. So that means you have borrowed 1,50,000 more, right? This 50,000 extra you have borrowed this year. This is cash inflow. So this will be added back. So one simple logic is, regarding assets, remember this in exam, shortcut, okay? First the logic, then the shortcut. Then you can apply the shortcuts if you know the logic. Current assets I will say, and current liabilities, not the fixed assets, okay? Increase in current asset means you have to subtract. Assets move in the opposite direction. If it is increasing, we have to subtract it, and if it is decreasing, we have to add back. For the liabilities, if it is increasing, you have to add back, and if it is decreasing, that means we have paid some amount, and if it is paid, we will subtract. So remember this, the assets move in the opposite direction and liabilities move in the same direction. Right? This is the shortcut for exam, that assets move in opposite direction, right? That means if there is an increase in the amount of current asset, without thinking, just subtract. Okay? And liabilities move in same direction. That means if there is an increase in the amount of liability, we will add back to the net profits, and if there is a decrease in the amount of liability, we will subtract that. Clear, friends? Okay, so this is the general rule regarding current assets and current liabilities, the shortcut for exam. Assets move in opposite direction, liabilities move in same direction. Increase in asset, subtract. Decrease in asset, add back. Current liabilities, increase in liabilities, add back. Decrease in liabilities, subtract. Simple. The logic you know. Trade payables, earlier it was 1 lakh, then 70,000. That means we have paid them 30,000 rupees. If we have paid, that means we have done a cash outflow, and this has to be subtracted from net profits. Earlier the trade payables were 1 lakh, then 1,50,000. That means we have borrowed 50,000 more. This involves cash inflow, so it will be added back. Clear, friends? So this is about the working capital changes. What is working capital changes? It refers to changes in the current assets and current liabilities. Clear? Remember, the current assets move in opposite direction and current liabilities move in same direction. Just keep this logic in mind. Okay? If you forget everything else, just remember this. Current assets move in opposite direction and current liabilities move in the same direction. Clear? I hope this much is clear to you. Now, what you have is, we have calculated net profits. We have calculated net profits before working capital changes. Right? Now you will say step 4 is working capital changes. Add back. What is to be added? Increase in assets or decrease in assets? What is to be added? Current assets move in opposite direction. So what we are going to add is decrease in current assets. Decrease in current assets, and liabilities move in the same direction. So increase in current liabilities. Increase in current liabilities will be added back. What is to be subtracted? Assets move in opposite direction. So what is subtracted? Increase in current assets, and liabilities move in the same direction. Therefore, decrease in current liabilities will be subtracted. Clear? So whatever the figure you get is cash flow from operations. Right? Now, step 5. Deduct income tax paid on operations. Income tax paid on the income from operations is to be deducted. If the income tax is not on operations but on some investment or some financing activity, then it is to be not deducted here. Right? Here I will say net of refund. That means if there is any refund, subtract the refund from income tax amount and the net amount we will write here. Now we get is cash flow from operations before extraordinary. See, initially we added back income tax and extraordinary items to reach at the actual profits that we have earned from operations. But these relate to the operations. Therefore, after calculating the actual cash flow, we will deduct the income tax and the cash flow from minus step 6 minus extraordinary. This can be plus minus. If there is an income, it will be added back. If there is an expense, it will be subtracted. So I will say extraordinary items. So the final figure that you will get is cash flow from operating activities. Cash flow from operating activities. Clear, friends? I hope it's clear. The important things are first the calculation of net profit before taxes. The second thing is to identify the items which are non-cash and non-operating. Third is relating to current assets and current liabilities. Current assets move in opposite direction. Therefore, if there is an increase in the current asset, we will subtract, and if there is a decrease in the current asset, we will add back. But the current liabilities move in the same direction. Increase in current liability means we have to increase, we have to add back, and the decrease in current liability means we have to subtract. Clear, friends? Then cash flow from operations, from that we have to deduct the income tax paid on operating activities, right? Net of refund. Then what we get is cash flow from operations before extraordinary items, and then we will add back or subtract extraordinary items. If it is an income, we will add back. If it is an expense, we will subtract. Right? Two important points regarding working capital changes. Write down. Regarding the working capital changes, I forgot two important points to tell you. The first one is not to include cash and cash equivalents. Not to include cash and cash equivalents in current assets. Why? Because you will get to know later on when we will complete all the three activities. Okay, just remember this right now. Not to include cash and cash equivalents in current assets, and then not to include bank overdraft and cash credit in current liabilities, because these are financing activities. Just remember these 2 points. Okay. So friends, this is about the operating activities. We have covered the maximum part of operating activities, a few small points are left that we will cover while doing the practical problems. So what are operating activities? The activities relating to the routine operations of the business. So identifying the routine operations of the business is very important. Then the second point important is whether the activities involve the actual cash outflow or inflow. So these two things are very important, right? So this is about the cash flow from operating activities, right? Today we have done adjusting the working capital changes. That means changes in current assets and current liabilities. And the simple rule I have told you, for the current assets, they move in opposite direction and the liabilities move in same direction. If there is an increase in the value of a current asset, we will subtract. If there is a decrease in the value of a current asset, we will add back. Then from the net profits before working capital changes, we will do the working capital changes. We will add and subtract what is to be added and subtracted. What we will get is cash flow from operations, right? On this cash flow from generations, we will pay income tax, right? We will pay income tax only relating to the operations, not the investing or financing activities, right? Net of refund. We will subtract the refund amount from income tax paid amount. What we get is cash flow from operations before extraordinary items. Then we will add back or subtract any extraordinary items. If it is an extraordinary income, we will add back. If it is an extraordinary expense, we will subtract. Finally, what we get is cash flow from operating activities. Clear, friends? So now in the next lecture, what we are going to do is the practical problems, right? In the next lecture, we are going to do is practical problems, right? Practical problems on cash flow from operating activities. Clear? Clear, friends? So if you have any queries, just send me email at ksjteaching@gmail.com, right? Okay, so that's all for this lecture, friends. Thank you so much.